Welcome to Mutual Fund Family.
Log on to mutualfundfamily.com for more info.
Hi friends, and welcome to the macro update. Inflation in India has clearly changed sides. The last two CPI headline rates came sub 3%. It would be interesting to look at factors that have caused such kind of disinflation and how these factors are likely to behave in the year ahead. So to begin with food prices, food inflation in India had remained stubbornly elevated at around 11% between FY7 and FY13. However, since the start of 2016, food inflation has averaged at around 4.5%. Behind this dramatic fall in food inflation, despite two drought years, are several structural forces such as weak rural demand, only a modest increase in MSP prices being announced by the government, various measures taken by the government for the debottlenecking of supply chains specifically for perishable items, the growing digital food market, as well as a very proactive management from the government in terms of imports as well as procurement and destocking of food items as and when required to augment domestic shortages. Reservoir levels, which are an imperative factor for gauging food inflation, are above normal levels currently, and monsoon prospects remain favorable. With food inflation so low, we expect the next two headline CPI levels to be below 2%. Talking about oil prices, despite OPEC announcing production cuts, oil prices are only trending lower. This kind of reflects the changing oil market dynamics on the back of substitutes available such as the shale gas. While upside risks from oil always persist, we expect some cushion from the resilient INR since the beginning of 2017. Another important factor that has led to this disinflation is the slowdown in growth. The recent GDP numbers revealed that the activity on ground was weak prior to the announcement of demonetization itself. We do not expect a significant recovery in growth given the sluggish investment cycle and the stretched corporate balance sheets. To that extent, we expect that the core inflation, which is the core inflation minus the transport and communication, is likely to remain contained. Talking now about inflation expectations. So inflation expectations have a tendency to feed onto themselves. So between FY9 and FY11, we were in a vicious cycle wherein higher inflation every year led to higher future inflation. However, post 2014 that has changed. We believe we are in a virtuous cycle where lower inflation is triggering lower inflation expectations, and that kind of is aiding lower inflation in the year ahead. With food and fuel inflation at such low levels, we expect the virtuous cycle of lower inflation expectations is likely to persist, and we do not see a significant upside on that. Other factors that are likely to influence the inflation trajectory in the year ahead, one being GST. While a lot was dreaded that GST could be inflationary, the government has very cleverly set tax rates bearing in mind the overall objective of containing inflation. In fact, we believe that if the lower tax rates are passed on to the consumers and if the input credit mechanism works very efficiently, then the GST implementation could add to no inflation. Other structural forces such as rural wages as well as MSP price announcements heavily lean on the past trend or the inflation that is seen in the previous year. We do not expect any kind of runaway inflation from these two forces. In fact, the MSP recommendations have been lower than what was seen for the previous year. On the other hand, however, some upside risks to inflation cannot be neglected. We have the 7th Pay Commission HRA allowances which are yet to be implemented, which will add to the headline inflation by around 100 basis points, both in terms of a primary impact as well as a secondary round impact. The secondary round effect could be limited because of the negative output gap in the system. One major concern is the series of farm loan waivers that have been announced by states such as UP, Maharashtra and very recently Punjab. In case other states follow suit, which will lead to worsening of the debt as well as the fiscal ratios, compelling the government for higher MSP price announcements that could lead to some amount of inflation going ahead. So looking at all these factors, we need to ponder upon factors such as whether the food disinflation will persist, leading to further lower inflationary expectations, whether the slow growth momentum will ensure that core inflation is contained, whether global factors in the sense that the Fed rate hikes or the global commodity prices are supportive of lower inflation. Considering an optimistic probability to these questions, we believe average CPI for FY18 could be somewhere around 3.5% without considering the impact of the 7th Pay Commission. So in a most likely scenario, the RBI is likely to achieve its 4% target on the headline CPI rate. Thank you all for your time and see you soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Thanks for watching. Drop a like, leave a comment, and don't forget to subscribe Mutual Fund family.